I demonstrated last week that passive indices routinely invest in expensive, slow-growth stocks, which creates a sizable performance drag. Here I quantify the scale of that underperformance. It is useful to think of the equity universe within a value and growth paradigm. Some stocks are expensive, with high price-to-earnings ratios for good reason. They have excellent growth prospects. But what about expensive stocks with low growth prospects? These stocks are potentially overvalued. Should investors avoid these expensive low-growth stocks? Quite possibly. But that isn't how popular indices work. A capitalization-weighted index includes all stocks. Fundamental values do not matter. Capitalization weighting only cares about the stock price. This is the topic of my latest paper, Fundamental Growth, with Research Affiliates colleagues. Even popular value and growth style indices include all stocks. For example, an equally weighted portfolio of Russell 1000 Value and Russell 1000 Growth is the exact equivalent of the passive Russell 1000. So stocks that are not included in the value portfolio are included in the growth portfolio and vice versa. How bad are the expensive, low-growth stocks? Our paper does the calculations. We constructed 4 equity portfolios based on book-to-price ratios and 5-year sales per share growth. These are fast growth and cheap, fast growth and expensive, slow growth and cheap, and slow growth and expensive. The excess returns for the first 3 are positive, yet the excess return relative to capitalization-weighted index is negative for the expensive, slow growth stocks. It is also negative with risk-adjusted returns. Our paper further shows that this performance is consistent through time. Over the past 55 years, the slow growth and expensive portfolio lags a passive cap-weighted index by nearly 2% per year. That means that a slow growth and expensive investor would be at least 75% less wealthy at the end of our sample period than if they had invested in any of the other portfolios. So what are the alternatives approaches? There are 2 obvious options. Number 1. Rather than invest in a capitalization-weighted portfolio of all stocks, we should filter out expensive, slow-growth stocks. Number 2. Style indices should focus on their style. Growth should focus on growth and value on value. Low-growth, expensive stocks have no place in either style index. For more insights on this topic, I encourage you to read the full paper is linked below.